Yo, what's up? Today we're cracking open a real stock research report on Constellation Energy, ticker CEG, the biggest nuclear power company in America. 10 sections. We're ripping through all of them, fast, in plain English. Quick disclaimer before anything else, this is not financial advice. Purely education. Nobody's telling you to buy anything. Alright, let's go. Section 1. The big picture. Who is this company, and why is it suddenly everywhere? 5 numbers, 30 seconds. This whole company costs about $90 billion to buy outright. 1 share, $2.52, down 27% this year, ouch. Revenue, $25.5 billion. And they're promising $11 to $12 of profit per share this year. Keep that PE number in your pocket, we're coming back for it. What do they actually do? Simple, they own power plants and sell electricity. But check this, 25 nuclear reactors, more than any other company in America. Then in January they dropped $29 billion buying another power company, Calpine, and instantly became the biggest privately owned power producer on planet Earth. Flip a light switch in a big chunk of the US? There's a real chance this company just powered it. Here's why everyone's obsessed. AI data centers are power-hungry monsters running full blast, 24/7, forever. America hasn't needed this much new electricity in 20 years. And tech giants like Microsoft and Meta don't want just any power, they want clean power that never sleeps. Solar naps at night. Wind stops. Nuclear doesn't care, it just runs. That's the entire trade. The competition, 62nd edition. Vistra, number 2 nuclear fleet, bigger retail game. NRG, millions of customers, but running on gas, no nuclear edge. Talon, smaller, regional player. Remember these 3 names, they show up again. Now here's the number that actually matters. Revenue up 8% last year, profit down 38%. Wait, what? How does more sales equal less money? Because electricity prices swing like gas station prices, up 1 month, down the next, and profit gets squeezed in between. Lock that in. That's risk number 1 for this entire stock. 3 futures on the table. Worst case, stock stays stuck under 240. Middle case, around 360. Best case, over 400. Notice something? Even the boring middle guess sits way above today's price. That gap is the whole reason people are watching this stock. But don't get hyped yet, 3 real dangers. 1. Profits ride on power prices they don't control. 2. They took on serious debt to buy Calpine. 3. The whole story leans on a couple of massive bets landing perfectly. And remember, the stock already dropped 27% this year, even while hitting its targets. The market is nervous. Noted. Section 2. Report card time. Every 3 months companies show their grades, here's the latest one. Straight A's. Revenue, $11.1 billion, up 64%, way above what experts expected. Profit per share beat estimates too. Beat the experts' guess? Stock pops. This one jumped about 4% the next day. 2 things actually matter here. 1. Most of that huge growth came from buying Calpine, not growing organically, real money, but not the same flex. 2. And this is the good part, they had surprise costs this quarter, storms, maintenance, and they still kept their full-year promise. A company that keeps promises when things go sideways? That's a green flag. Quick gut check, you'll see 2 different profit numbers here, 449 and 274. Which one's real? Both, just 2 camera angles. One's the strict accounting rulebook number, swinging wildly from paper gains. The other is management's here's how we're actually doing number. Most investors watch the second one. 3 things to circle. Early August, the next report, first clean quarter with Calpine fully baked in. Updates on restarting a nuclear plant called Crane, huge deal, we'll get there. And any new mega contract with a tech giant, those have made this stock jump before. Section 3. Red flags. Time to play detective and hunt for what could bite investors. Score, 4 out of 10. Lower is better, so this is moderate. Not clean, not scary. 0 flags in the danger zone. Let's see what's actually flagged. Good news first: cash flow, accounting, transparency, all clean. Now the 3 yellow flags. Debt, a 6, the $29 billion shopping spree was paid for mostly with borrowed money. Margins, a 5, that's the profit roller coaster from before. And insider selling, also a 5. This one's juicy, stick around. February, the CEO sold $25 million of his own stock. 2 other execs sold $12 million more. Weeks later, the stock tanks. Now, execs get paid in stock, so some selling is normal, it's basically cashing a paycheck. But several bosses, big amounts, right before a drop? Watch what people do, not what they say. Section 4, my favorite. The moat. Think of the company's profits as treasure in a castle. The moat is what keeps competitors from storming in and stealing it. 39 out of 50 ahead of everybody, and the moat's actually growing, not shrinking. Why? Nobody can build a new nuclear plant in America anytime soon, just the paperwork takes over a decade. Their 25 reactors already exist. Basically impossible to copy. Head-to-head scorecard, CEG first column. Perfect fives everywhere, customers locked into 20-year contracts, the biggest fleet on the planet, and a legal wall that stops anyone from building competing reactors. But real talk, a 2 in data assets. Rival Vistra actually beats them there, more retail customers means more data. Nobody wins every category. Not even the leader. 3 walls holding up this castle. An irreplaceable nuclear fleet. A legal moat blocking new competition for a decade. And 20-year contracts turning shaky day-to-day income into steady, locked-in cash. Unpredictable money becoming predictable money, that's the whole upgrade. Nothing's bulletproof though. Vistra's chasing the exact same tech giant deals. And down the road, smaller nuclear reactors or a wave of new gas plants could make always-on clean power a lot less rare. And rare is the entire reason this moat exists. Section 5. The price tag. Rule number 1 of investing: an amazing company at a terrible price is still a bad buy. So, is this one overpriced? That PE number from earlier, 21, means this: pay $21 today for every $1 of profit next year. A boring safe utility usually runs 15 to 17. A hot tech stock, 40 plus. So 21 is a premium, but cheaper than last year's 25. Meanwhile, the average Wall Street target sits 30% higher than today's price. Look at NRG, a PE of 161. Are they 8 times more expensive than CEG? No, their profits basically collapsed, so the math goes haywire. Lesson: a weird ratio means ask why, don't just trust the number. Real takeaway here: the whole power sector got hammered this year. This isn't just a CEG story. Verdict: fair to cheap. You're paying extra for an uncopyable nuclear fleet and rock-solid contracts, but after a 27% drop, a lot of the hype tax already got paid by somebody else. Only got room to track 3 numbers? Make it these: the auction prices plants get paid just to stand by, actual cash flow versus the promise, and how much revenue is locked into contracts versus riding the daily market. Those 3 basically decide the whole stock. Section 6. Crystal ball math, officially called a DCF. Scary name, simple idea: guess all the cash this company makes over 10 years, then translate it into today's dollars. It's a guess only as good as the assumptions behind it. Here's the punchline. Worst case, 220, 13% below today. Middle case, 360 to 400, 50% above. Best case, up to 485, almost double. Stock's sitting at 252 right now. When even the boring middle guess screams 50% upside, either the market's missing something, or the assumptions are too rosy. That tension is the whole debate. This is the recipe card behind those numbers: growth rate, profit margin, and a dial called WACC, basically an impatience rate for future cash. Nudge these dials just a little, and the answer swings by hundreds of dollars. A DCF isn't a bullseye, it's a fuzzy range, and you should treat it that way. One honest line from this report: the bull case needs 2 good things to happen at once: premium prices and record capacity prices, for a full decade. Stacking multiple ifs together is exactly how investors get burned. Enjoy the upside math. Respect the downside column. Section 7. The calendar. Real dates, real events, that could actually move this stock. 9 events on the radar, for high confidence. Closest one, earnings, early August. Next 3 months, August earnings is the first clean look at the combined company. Listen for talk about a record-breaking power auction. Plants literally get paid just to promise they'll be ready when the grid needs them. One caution flag, a batch of shares just got unlocked to sell, which can pressure the price for a bit. Next 6 months, they're required to sell off some plants, $5 billion, straight toward paying down that debt. Then a November update checking progress on the big cash promise. And the headliner, the Crane Clean Energy Center. A nuclear plant that was completely shut down years ago, coming back from the dead in 2027. Every megawatt it will ever make. Already sold to Microsoft, locked in for 20 years. This has basically never been done before. That's why Crane is ranked the single biggest catalyst in the whole report, bigger than any earnings call. Pull it off, and it's the blueprint for reviving more shutdown reactors. Blow the budget or the schedule, and the whole AI power story takes a hit. Section 8. Who's actually driving this bus? Because when you buy the stock, you're trusting these people with your money. 44 out of 60, solid. CEO Joe Dominguez has run this since 2022, and before this year's dip, the stock had more than tripled under him. The highlights, they say what they'll do, then actually do it, near perfect guidance accuracy. Communication scores a flat-out 5. They're funding buybacks, growing the dividend 10% a year, all while paying down debt. The soft spots, that Calpine bet is still being digested, and the COS personal stake, $41 million, sounds huge, but it's a tiny slice of a $90 billion company. And yeah, the blemish you already know. $38 million sold by 3 execs, right before the slide. Bottom line on management, built for the long game, 20-year contracts, multi-year plans, not a team playing for the next quarter. Section 9, the fun one. Bull versus bear. An optimist and a pessimist go 8 rounds. Let's watch the best ones. Final score, Bulls win 6, Bears win 2. Blowout, right? Not quite, those 2 bear rounds are exactly why this stock is down 27%. Let's replay them. Round 1, growth. Bull says revenue's up 64%. Bear fires back, you bought that growth, strip out the acquisition and it's about 5% a year. Fine. Ordinary. Lesson, always ask if growth was grown or purchased. Round 2, price. Bull says the stock's 30% below what analysts say it's worth on sale. Bear says analysts cut their targets even after a great quarter, and their math bakes in premium prices lasting a full decade. Uncomfortable truth? Both are true at once. Welcome to investing. Skipping ahead to the spiciest round, management. Bull points to the track record, promises made, promises kept. Bear points to one thing, the CEO selling $25 million right before the slide. Words versus actions. I'm not settling this one for you, you get to decide. Final ruling, Bulls win, narrowly. Why? The Bull case rests on documented facts, signed contracts, real demand. The Bear case leans on a collapse that hasn't happened yet. But there's homework, verify the real debt number, verify how much revenue is truly locked in, and watch if that promised cash actually shows up. Last one. Section 10, the beginner cheat sheet. Everything, on one page, for someone brand new to stocks. What do? Own power plants, mostly nuclear, sell the electricity. That's it. Understood that? You now know this company better than most people scrolling a trading app. 3 ways they make money, lemonade stand version. 1. Sell lemonade at today's street price, that's selling power on the open market. 2. One rich customer pays you every day for 20 years at a fixed price, that's the Microsoft-style contracts. 3. The neighborhood pays you just to promise your stands open during a heat wave, that's capacity payments. This entire stock story is the shift from option 1 to options 2 and 3. Final checklist, 3 green checks, easy to understand, genuinely growing, risks you can actually name. 3 question marks, the new debt, the premium price, and homework left to do, real debt levels, contracted revenue share, and what Crane will truly cost. Not a single red X. But not all green either. That's the whole story in one screen. Let's land this. 5 things to remember. 1. Biggest nuclear fleet in America, basically impossible to copy. 2. AI needs its power, and tech giants are locking in 20-year deals. 3. Serious new debt from the Calpine buy, the single biggest risk here. 4. Profits swing hard with power prices, that's just the business. 5. The stock's down 27% while most scenarios say it's worth more, the tension is the whole story. One more time, education, not financial advice. Nobody knows the future, not me, not this report. Do your own research, talk to a real advisor before risking real money. If you learned something, like, subscribe, catch you next time. Peace.